If you are looking at your portfolio right now and wondering if you should move to cash, you are not alone. There is a very real temptation to exit the market entirely until the volatility subsides. The global news cycle is tense. Every morning brings new headlines from the Middle East, and it is easy to assume that a single escalation will send global oil prices and your domestic investments into a tailspin. Locally, there are concerns about mixed forecasts for the upcoming monsoon season. A weak monsoon directly hits rural consumption, creating a drag on domestic economic growth. And sitting behind both of those issues is the arrival of massive IPOs from companies like GEO and the NSE. There is a lingering anxiety that these mega issues will drain all available liquidity out of the market. Despite these pressures, the data indicates we are not positioned for a catastrophic crash. Instead, as the numbers show, the market is transitioning into a phase of grinding upward against heavy resistance. This comparison matrix maps out the competing forces currently driving the market. Even if we don't reach the 18% targets of a full-blown bull run, the current expansion in credit growth and the investment cycle makes a 15% earnings growth rate for the Nifty 50 a highly probable baseline. On the left side, we have the noise pulling your attention: border tensions, unpredictable weather patterns, and the perceived threat of dry liquidity. On the right side, we have the math. We see a robust investment cycle, strong commodity prices holding their ground, and a growth differential that places India well ahead of competing emerging markets. By reacting to every geopolitical headline, you are making a specific exchange. You trade the high probability of that long-term 15% earnings growth for short-term psychological relief. That is an extremely expensive trade. Building resilience requires structural adjustments to ensure the math of the market works in your favor, regardless of the news cycle. This quadrant chart isolates how to build that structure. On the vertical axis, we plot economic sensitivity, how sharply a sector reacts to current events. On the horizontal axis, we map the time horizon required for the investment to mature. We start in the top left quadrant. This area holds sectors that offer immediate returns but are highly sensitive to the broader economy. The clearest example here is banking and financial services. When credit growth picks up, this sector responds rapidly. But an over-allocation here creates a vulnerability. If a monsoon fails or an external shock hits, these cyclical sectors take the first hit. To counterbalance that risk, you need immediate stability. That requires moving into the bottom left quadrant, sectors with low economic sensitivity. Healthcare fits into this space perfectly. It acts as a secular defense because demand for medical care is naturally insulated from fluctuations in global oil prices or border tensions. Pairing these two quadrants effectively limits your exposure. It ensures that a significant portion of your wealth is disconnected from the headlines causing market panic. This balance carries a strict trade-off. You cap your extreme peak gains during a flawless bull run, but in exchange, you secure structural resilience against unpredictable news cycles. Forward-looking. With the immediate risks managed, we can look to the right side of the quadrant. This area maps the long-term structural tailwinds that will define the next 3 to 5 years. Once the current geopolitical dust settles, specific megatrends will dictate market leadership. A resilient portfolio leaves dedicated space with these themes to develop. The first theme is the surge in domestic manufacturing. We are seeing a rapid expansion of local production capacity across consumer and industrial goods. The second theme is the strategic pivot toward indigenous defense capabilities, ensuring military supply chains are controlled locally. And the third is the pursuit of energy security, transitioning away from imported oil dependency toward vast domestic renewables. Deploying capital into these megatrends means accepting near-term volatility. You're locking up funds in sectors that require time to fully mature. However, many investors are hoarding cash rather than funding these trends. They're waiting on the sidelines, convinced that upcoming mega IPOs like GEO and SBI will suck all domestic liquidity dry. High-quality IPOs act as market stabilizers. Institutional data suggests they provide a productive outlet for domestic capital that might otherwise distort current valuations. This flowchart models the actual path of domestic capital. When marquee names offer high-quality placements, domestic liquidity flows into them, providing a wide, stable base for the broader market. If those IPOs do not exist, that exact same liquidity has nowhere to go. It forces its way into the current pool of stocks, driving valuations up into expensive bubble territory. By hoarding cash to protect yourself from an IPO liquidity drain, you are misinterpreting a protective feature of the market as a bug. The reality of the current market is clear. We are likely not going to see explosive 17 or 18% earnings growth this year, but a highly dependable 15% is firmly on the table for a properly structured portfolio. This decision tree outlines your next steps, depending on your current psychological state and how your capital is currently positioned. Path A is for the anxious investor. If you are losing sleep over Middle East headlines and inflation reports, you are holding too much risk. The stress of that trade-off is not worth the cost. Your move is to rebalance away from heavy cyclical exposure and move capital into secular anchors like healthcare. Path B is for the liquidity watcher. If you are sitting on a pile of cash, waiting for the mega IPOs to crash the market, you are waiting for an event that will not happen. Stop viewing those IPOs as a threat. Deploy that cash either directly into those high-quality placements when they open, or into the long-term manufacturing and defense megatrends. Ultimately, you have to stop trying to predict the endgame of uncontrollable global conflicts. Focus only on the inputs you can control. Maintain a balanced barbell of cyclical and secular assets, and let the natural growth differential of the Indian economy do the heavy lifting for you.